This is On The Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On The Charts podcast, episode 200 for Monday, 22nd of May 2017. US stocks followed through after Thursday's gains on back of a strengthening oil price. There was some mixed rhetoric in the market and in the media on the outcome of some adjustment to the Trump presidency. Ray Dalio, founder of the world's largest hedge fund, suggested the US stock market would fall about 10 to 11% if Trump was impeached. On the other hand, Jeremy Siegel, a prominent market bull and one of the first to call Dow 20,000 way back in 2014, suggested if Trump were to resign that the Dow would actually rally 1,000 points. His argument is no Trump equals less drama and high stability, and therefore tax cuts, infrastructure spending and deregulation. Your guess is as good as mine, but the recovery from Wednesday's sell-off is proving to be very positive. At the close, the main S&P index was almost 0.7% higher, albeit booked a loss for the week. Shares in Deere jumped 7% after positive earnings, and Autodesk rallied nearly 15% after announcing a shift to a subscription-based software model. More retailers lost ground on Friday, with Foot Locker dropping over 16% on weaker-than-expected sales data. Australian markets were buoyant from a positive offshore leads and strongly advancing iron ore prices today. Chinese steel futures rose 6% and in turn pulled the likes of Rio and Fortescue higher. Western Areas was also a standout performer, jumping over 6% and away from recent yearly lows. Shares in Surf Stitch continue to implode, losing 27% today after issuing another profit warning. The online surf and skatewear company that once traded at $2.20 just back in 2015 sunk to a low of 7 cents. Banks were mixed today, with ANZ and NAB slightly in the red, but Westpac and Commonwealth Bank quite strong. Other strong performers were energy shares led by Origin, up 4%, and Woodside, which added 2%. At the close, sectors were higher to the tune of about 0.7%, except healthcare and consumer staples. The broader market closed about 0.8% up on the day. A few stocks of interest. Structural Systems Limited, or SRG, the code, added almost 6% today. The company has an interesting story and was originally a privately owned post-tensioning specialist, but is now a diverse contractor that specialises in dealing with complex design and construction contracts. It's been involved with iconic projects such as Sydney Centrepoint Tower, Stadium Australia, Rod Laver Arena in Melbourne, and the Emirates Tower in Dubai. The company pays a 5% dividend, recently reported a 45% increase in half-year revenue, and has a very diverse revenue stream. The balance sheet is also strong, with $25 million in cash and on hand and debt of $4.8 million, which is due to be paid down over the coming 12 months. Now, technically, the share price progression looks very impressive. During 2016, the company rallied from a 60 cent low to $1.90 and is now retracing some of that in what is deemed to be a healthy correction. Usually at this stage of the trend, prices will take a breather about 50 to 60% of the prior advance, which appears to have been seen, and any upside traction from here may well be a trigger for new highs. And Xero Limited has recently shot higher through resistance. The New Zealand-based software company develops cloud-based accounting software for small and medium businesses. Recent revenue growth was on par with expectations, but they did show margins were improving quicker than anticipated, and cash burn was materially reduced. The company is supposed to be in a positive cash flow state by next year, and technically, the stock has been trading in a range since July last year, with the upper boundary sitting just below $20. This was recently penetrated, and prices are now consolidating below a recent $23 high point, and we're ideally looking for another week or so of this posturing before moving higher towards the next target, which stands at $26. This near-term consolidation should provide quite a low-risk opportunity for that move higher. My name is Nick Radge, and I look forward to seeing you on the charts tomorrow.
On The Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.